Hello, everybody. Welcome to the Enlightened Investor. I'm your host, Joshua Lure, here in beautiful Peoria, Illinois. And it's been a while since we've come back and had a video and an episode, so we wanted to kind of fill you in on what's been going on in the economy. There's just seems like we've been over the Rubicon on so many things, whether it be fiscal policy or debt or inflation. And I think it's time to kind of update what's going on. And our boy Mike Mahoney, the second half of the Enlightened Investor team, is out on assignment. He's probably biking another 50 miles here, incredibly in the wind. He can bike incredible distances. So we'll see him again soon. I think tomorrow. We're gonna try to film an episode as well. So let's go ahead and get right into it. Today's episode is going to be about economic outlook, number one. Number two, housing outlook. And then number three, just a little bit on investing during these inflationary times and quantitative tightening times. So we all know, let's do the economic outlook first. It's hard to predict the future, isn't it? And, it's like, there's no crystal balls. So what we do is I rely on official sources like the Federal Reserve, as well as economic indicators. And so the first one thing I want to show you is this slide on the what's called the Atlanta Fed's GDP Now estimate. And they've been pretty accurate of kind of forecasting what the next quarter's GDP is going to be. And you can see here that that they're forecasting third quarter GDP estimate for July, August, September to be about 1.6% positive. So that's some good news. The country is going to get above zero GDP growth. We've had two consecutive quarters of negative GDP growth, which is technically a recession, and that's definitely no good. So we want to get ourselves out of that, and it kind of falls in line with the blue chip consensus as well. So looks like this next quarter, and especially now that we've got these new fiscal policy, the Inflation Reduction Act and the student loan act that Biden had, those are going to be pretty stimulatory, which should help the GDP estimate. Other things I like to look at are these things called economic indicators. And you can see here there's 7 economic indicators. There is the yield curve, which is my number one indicator, money supply growth, housing starts, consumer sentiment, the ISM Manufacturing Purchasing Manager Index, monthly change in jobs, and lastly, crude oil price. And in column 2, there's a threshold. So if you are above that threshold number, that's going to be positive. If you're below that threshold level, that's going to be negative, and that's going to be red. So we can see in 2007, in September, that 5 out of the 6 indicators were red. Today, we've got 4 out of the 7 indicators are red. 3 of the 7 are green. So we're kind of in a very precarious situation. Like the negative yield curve being 50 basis points, that's a pretty bad signal. My probit estimation would suggest we'd have about a 44% chance of a recession the next 6 months. Yet at the same, consumer sentiment's it's the worst ever, 58.2. And then a strong positive one is the monthly change in jobs at 528,000 new jobs created in July. So, what an interesting time where we've got, 11 million job openings and only 5.6 million job unemployed individuals. So about 2 for 1 jobs per unemployed person. So kind of some incredible stuff going on. I know it doesn't make a lot of sense for me either sometimes. And there's a lot of pain going on out there, especially with regards to inflation. And the good news is I think that inflation has peaked. We talked about inflation many times over the last year. We've had our show on for about a year now, and inflation's been one of our big issues. And you can see that inflation, all items peaked in June at about 9.1. In July, it came down into the mid-8s. Core inflation, which you take away food and energy, peaked in March of 2022 and has slowly been moving down below 6%. I think it's important to note that I'm expecting inflation to head down further percentage growth. But that doesn't mean prices are going to go down. We have elevated our prices and they're higher now. So the growth of those prices will probably be by the end of the year 5%, 4.5%, not 8 or 9, but it's going to moderate, but still be the growth will still be kind of high. So that is unfortunate. And inflation does hurt. Inflation is punitive. It does eat our fiat currency. We definitely need to hold assets that go up in value. And so here's the next one I want to show you is that while it's important to hold a emergency fund, we recommend that for everyone, that all fiat currency ends up going to zero. It's not backed by anything. So for example, this is a graph here that looks at consumer price index for all urban consumers, the power of a consumer dollar in the United States. And when I was born in 1972, I just turned 50, yippee. My putter's been working well. Thanks to Mike, got me a new putter. In 1972, the value of the dollar was indexed at about 240. If you go 50 years later, the value of the dollar is indexed at about 38. So that's an 87% loss in purchasing power. So if my grandpa, grandma, or my mom and dad gave me some dollars and I stuck it in a safety deposit box for 50 years, I pull that dollar out. 50 years later, in 2020, it's worth 13%. 13% of the purchasing power it had in 1972. So Ray Dalio's book, The Changing World Order, talks about how fiat currencies all go to zero. You can see here that this is a look from 1850 to 2020, and for currencies relative to gold for the United States, Japan, Great Britain, Germany, Spain, France, China, other countries. You can see if they haven't disappeared, they've all gone down about 90 to 95%. So inflation definitely is something we want to be leery of when we use fiat currency. Jerome Powell, J. Powell, smashed the market on his Jackson Hole speech on Friday of last week. The Dow Jones went down 1,000 points. He made three, I read over his materials and I thought he had three valuable points. Let's take a look at each quote. Quote number one: the pain for households and businesses are a price to pay for bringing down inflation. So right now, folks, unfortunately, the only way that we can bring down inflation is through demand destruction, higher interest rates, and that's what we've been seeing. Quote number two: without price stability, the economy does not work for anyone. It doesn't work for businesses, it doesn't work for households, it doesn't work for rich or the poor. His last quote is: the burdens of high inflation fall heaviest upon those who are least able to bear them, namely the low-income Americans. So Jerome Powell was very hawkish at his last meeting on Friday, and interest rates are going to go up. They're going to go up to about 3.75 to 4% Fed funds rate by the end of the year. The Federal Reserve Open Market Committee is going to meet 3 more times in September, in November, and December, and they're probably going to do a 75 basis point hike, a 0.5% basis point hike, and a 25% basis point hike, which gets us from 2.25 to 2.5 all the way up to about 3.75 to 4% interest rates in the future. So how does that affect housing markets? So that's the second thing I want to look at is housing markets. Housing markets definitely look at the 30-year fixed mortgage. You can see that the 30-year fixed mortgage has spiked from about 2.5% early last year up to 5.5%. And the demand for mortgages has really declined to a 21-year low. New home sales are falling fast, down to about 500,000, well below 2018-17 levels. And the last and most important thing is for most Americans is that housing has never been more unaffordable. The median price of a new home in the United States is now 6.7 times higher than the median household income. So there's demand issues. Look for another 10 to 15% decline in housing prices going forward. Hold on just a second, all right? So how about how does inflation affect historic equity returns? And what we're going to do is look back in 1966 to 1982. There's a period of time, a 16-year period of time when inflation ran high. And this is showing you that inflation increased about 3x over that 16-year period. And the S&P 500 did about the same. So really, you were able to kind of hold your purchasing power with inflation, but not with bonds. Other types of asset classes like dimensional U.S. small cap value and large cap value went above that, maybe 10x, 8x, 6x. Once inflation breaks, you can see that all equity classes outperformed inflation by a good amount. And that's what we're looking for, is that once inflation breaks, we're going to start to see not just S&P and value stocks do well, the whole markets generally tend to go up. So folks, definitely, volatility is a normal part of investing. The best defense is making a plan based on your risk and your age and your risk tolerance, and sticking to it. There's been 8 bear markets since 1980 and 6 recessions. So we're in one now. It's definitely hard to hold during these times, but that's definitely what we should do. So again, thank you today for watching our Enlightened Investor show. We'll be coming out with some new episodes in the future, especially with our boy Mike, which I know you all can't wait to see again. So take care, folks. We'll see you next time. It's Dr. Luer, out.